Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Monday, everybody. I hope you had a restful weekend, and I wish you all a productive week ahead. As we normally do on a Monday, today's video will be focused on the economy. And first up, Beijing's bruised economy may have some positive news. Then we will move on to the more concerning updates. According to the official Manufacturing Purchasing Managers Index, published by the National Bureau of Statistics yesterday, Sunday, China's manufacturing activity expanded in March for the first time since September. I appreciate that some viewers will refuse to accept official numbers. However, it is still important that we take note of them. The official PMI rose to 50.8 from 49.1 in February. That beat the median forecast of 50.1 by economists in a Bloomberg survey and a Reuters survey, and was the best reading since March last year. A gauge of non-manufacturing activity climbed from the previous month to 53, compared with an estimate of 51.5. Today, Monday, saw the release of the Caixin China General Manufacturing Purchasing Managers Index, PMI, which seeks to give a more independent snapshot of the sector. According to this PMI, activity in China's manufacturing sector expanded at the fastest pace in 13 months in March, with growth in both domestic and overseas demand accelerating. The Caixin PMI rose to 51.1 in March from 50.9 the previous month. The PMI is one of the earliest available monthly indicators of business activity in China. Manufacturing accounted for just over 26% of China's GDP last year. Now, despite these positive rates, the National Bureau of Statistics warned that further state support for industry was needed, with companies suffering from, quote, insufficient market demand, end quote. Underlying worries among China's trading partners that industrial overcapacity could spill over into export markets. This, we have already seen, has sparked pushback from both the Americans and the Europeans. A senior statistician at the National Bureau of Statistics said yesterday, quote, in March, as companies accelerated their resumption of work and production after the Spring Festival, market activity increased. End quote. Nevertheless, this PMI data, combined with the news from last Wednesday that industrial profits in the January-February period hit a 25-month high, is good news for policymakers in desperate need of policy space to deal with the housing and fiscal crises. On top of that, there has been much speculation in recent years about whether China is losing its allure as a place for business and investment amid slowing growth, an uncertain national security climate, and regulatory actions that some perceive as arbitrary. As we saw last week, General Secretary Xi Jinping even had to tell a meeting of U.S. executives that China's economy is not collapsing. Tao Wang, chief China economist at UBS, said the PMI figures indicated that export orders rebounded, while domestic activity picked up in the second part of March. Most of the subcomponents of the PMI improved, except factory gate prices, quote, which suggests consumer demand may still be relatively weak, end quote. The subcomponent on employment also only showed a small improvement. Wang Zhe, a senior economist at Caixin Inside Group, behind the Caixin PMI, expressed, quote, a slew of policies introduced earlier this year to stabilize growth are gradually having an effect, end quote. However, he cautioned that given the economic headwinds, including subdued employment and insufficient demand, achieving around 5% growth this year, the official target, quote, will require consistent efforts to accelerate growth while improving the quality and efficiency of economic development, end quote. Meanwhile, today, U.S. outlet Bloomberg reports that iron ore dropped to the lowest level in 10 months. Quote, as China's years-long property crisis pressures prices even amid wider signs of a pickup in economic growth, end quote. The steel-making material fell as much as 3.9% to 96.25 a ton, US dollars a ton, in early trading on Monday on the Singapore Exchange. Futures for iron ore have tumbled since early January as investors adjust to a weaker demand outlook from the country's real estate sector. Bloomberg reports that the China Iron and Steel Association last week warned that the property downturn and relatively weak infrastructure were delaying a recovery in steel demand. The steel industry's Purchasing Managers Index for March sank to 44.2, its lowest reading since May last year. And China's housing outlook looks to be increasingly much worse than initially feared. According to preliminary data from China Real Estate Information Corp, published today, Monday, the value of new home sales from the 100 biggest real estate companies slid about 46% from a year earlier to 358 billion yuan, $50 billion, following a 60% decline in February. As we explored over the weekend, China's protracted property sales has put huge pressure on China's biggest builders and eroded the balance sheets of the largest state-owned banks as their bad loans swell. Last week, Fitch Ratings downgraded the credit rating of some builders into junk territory, including Wanke and Long4 Group Holdings Limited. The ratings agency also cut forecasts for the housing market and now expects a 5 to 10% fall in new home sales this year. Next up, we continue with China's economic updates. But just quickly, if you like what I'm trying to do here with China Update and you'd like to see the channel grow, hitting the like button and subscribing is the biggest help you can do to achieving this end. And for those who want to help keep the channel financially sustainable, my dedication is to have the channel primarily subscriber supported. The vast majority of the funding comes from subscribers like you rather than corporate sponsors. I think this is the best way to keep the channel independent and not distracted by corporate sponsorships. Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, as always, for the ongoing support. Next up, this update blends the economy with foreign policy. Last week, Beijing announced that it will lift tariffs on imports of Australian wine after more than 3 years. Beijing imposed the tariffs in 2020 in response to a call by Australia's then Prime Minister for an international probe into the origins of COVID-19. The tariffs led to a near-total collapse in the Australia-China wine trade, with some tariffs as high as 200%. US-based Wall Street Journal writes over the weekend that Australia's trade relations with China remain fragile, and several sources of friction remain. Re-establishing supply chains to China will cost time and money. Treasury Wine Estates said it plans to set up investment to support its brands in China, but this extra spending means it doesn't expect the removal of the tariffs to add much to its profit in the near term. Martin Cole, chief executive of Wine Australia, expressed on the news, quote, "Mainland China remains an important market for the Australian wine sector. However, the wine market in mainland China is different now to what it was at the end of 2020. End quote. Wine Australia pointed out that wine imports to China totaled 248 million litres in 2023, down around two-thirds on volumes 5 years earlier. Next up, and finally for today's video, according to stock exchange filings released last Thursday, China's so-called Big Three state-owned airlines remained in the red in 2023, despite narrowing losses from 2022, as international travel continued to lag pre-COVID levels. Chinese financial media outlet Caixin reports that Shanghai-based China Eastern Airlines Corp reported the largest loss among the trio, 8.17 billion yuan, $1.13 billion for 2023, even as its revenue leapt 145%. Guangzhou-based China Southern Airlines Co. Limited, the country's largest carrier by number of passengers, saw a deficit of 4.2 billion yuan for 2023. Still, its revenue jumped 83% year-on-year. The outlet reports that flagship carrier Air China Limited saw the best recovery of the three, reporting a 1.05 billion yuan net loss compared with 38.6 billion yuan in 2022, and its revenue also surged, this time 166.7% year-on-year. Caixin reports, quote, Air China attributed its surging revenue and shrinking loss to measures including adding flights at major domestic airports and expanding routes in countries involved in the Belt and Road Initiative. In 25 Belt and Road countries, the airline's flight numbers were close to 90% of 2019 levels. It also cut costs across its business. End quote. The piece continues to explain that China Eastern Airlines faces an array of challenges. Because much of the carrier's business comes from shorter routes, it has been hurt by competition from high-speed rail. Also, the recovery in its key routes to Japan and South Korea have been relatively weak. According to data from the Civil Aviation Administration of China, the number of international flights operated by China's Big Three is estimated to grow to about 6,000 a week this year. But this is still about 20% below pre-pandemic levels. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you all tomorrow.